let me ask you something. Why so many CPA candidates lose points on foreign currency questions in FAR? It is not because the topic is difficult. It is because they don't understand the life cycle. If foreign currency transaction confuse you, you are not alone. But once you understand the transaction life cycle, the entire concept becomes surprisingly simple. In this video, I am going to walk you through the foreign currency transaction life cycle step by step using a simple visual framework. I am Shamim Hassan, a US CPA, and welcome to your CPA School. If this explanation is helping you understand the concept more clearly, make sure to like this video and subscribe to the channel. Remember, success in the CPA exam is not about studying harder. It is about understanding the concept clearly. Keep learning, keep improving, and I will see you in the next lesson. Don't forget to like, subscribe, and press the bell button. The title of today's presentation is Foreign Currency Transaction Lifecycle. In this video, we will discuss on foreign trade, import and export, how to determine initial value, how to record transaction journal, how to remeasure at the balance sheet date, how to deal with remeasurement loss or gain, and how to settle the account at the settlement date. And finally, we will test our knowledge. Okay? Foreign currency transaction arises from foreign trade or international trade. A company can buy goods from a foreign country or countries. We call it import. Import creates accounts payable. Similarly, a company sells goods to a foreign country or countries. We call it export. Export creates accounts receivable. You need to determine value before recording the transaction into your books of account, right? The formula of value determination is foreign currency unit times the spot rate equal to value. Now look here for import. The foreign currency unit times spot rate on transaction date. So if it is a 10,000 foreign currency unit and the spot rate is $0.55, then the value will be 5,500. Means you need to record this transaction for the value of 5,500. Remember, import creates liability. The other one for export, similar transaction, similar type, but you are selling in this case. The similar value, but it creates asset because export creates account receivable, right? Recording transaction from foreign trade. Foreign trade, two types, import, export. Import can be inventory, import can be not part of inventory. If it is inventory, the journal will be purchase account debit or inventory account debit, accounts payable account credit. In case of not inventory, related account debit, accounts payable account credit. For export, if you are selling inventory, the sales account credit, account receivable account debit. If it is not part of your inventory, then account receivable account debit, related account credit. Here, account receivable account or accounts payable account. These two accounts are monetary items. So these accounts, receivable or payable, should be remeasured at the time of reporting date. Every foreign currency transaction follows a three-stage life cycle. Think of it as a journey. Transaction date, reporting date or balance sheet date, settlement date. Let me explain. First, a company enters into a transaction in a foreign currency. Maybe it buys goods from a supplier in another country. Second, before the payment is made, exchange rate may change. At the reporting date, the company must update the value. And the third is the settlement date, when the payment is finally made. The three dates you need to remember. You can remember it easily. Just remember three-date dance. The foreign currency life cycle, foreign currency transaction are remeasurement problem because accounts payable or receivable, the asset or liability exists. Only its USD equivalent change. That's why you need to remeasure it. The transaction date means recording date, the initial asset or liability at a spot rate, right? What did we agree to pay, right? Balance sheet date, year end, mark to market using year end spot rate. The balance sheet date, the year spot rate can be different from the spot rate of the transaction date, right? In that case, either unrealized gain or loss can be happen, and it need to report to income statement. What do we go right now? And you know the balance sheet always prepared on the basis of true and fair view. That's why you need to change it. And the other date is settlement date, means paying date, adjust to final spot rate. So in that case, the spot rate might be different, and the different from the balance sheet date to this different. Either you make gain or loss, right? Remember, ignoring any date breaks the audit trial. Here is a case study. Scenario: US company buys goods for 10,000 foreign currency. Stage 1, September 22 transaction date. Spot rate 0.005. So your liability is 5,500, right? The stage 2, reporting date on December 30 year end, 0.7. You see it is increased. So how much is increased? 0.15. 0.15 times 10,000, how much? 1,500. So now you need to pay 10,000 times this. So the difference is unrealized loss because liability increased. Unrealized loss where to report? On income statement. Then settlement date, March 20, 0.65. So your settlement rate is, so you are going to pay less, not 7,000. Now you are going to pay 6,500. So 500 gain. Also should to report higher on the income. Who wins when the dollar moves? This is the matrix. From this matrix, we can understand there is a dollar, weak position, and a strong position. This is weak position, a strong position. And the first row shows payable, and the second row shows the receivable position. And we see this is a gain position for receivable. So receivable gain when? When the dollar weak. Payable gain when? So when the dollar is strong. So payable love a strong dollar, receivable love weak dollar, right? Memory anchor, payable love a strong dollar, receivables hate a strong dollar, right? They love weak dollar. And there is a direct code. Do you know what is that? The domestic price of 1 unit of foreign currency. It is very important to learn. There are two codes, direct and indirect. So here is one direct, the other one will be indirect. So domestic price of 1 unit of foreign currency, it is a direct course, domestic price. And if you see foreign currency price of 1 unit of domestic currency, that will be treated as indirect. And there is the ultimate track transaction and translation. We are handling with the transaction, not translation right now. So remember, foreign currency transaction always hits net income. Time to test our knowledge based on today's learning. Let's test your understanding. Here is the question. If a company purchases inventory in a foreign currency and the exchange rate changes before payment, which account creates the foreign exchange gain or loss? Is it inventory or accounts payable? Think about it. The correct answer is accounts payable. Why? Because it is a monetary liability and monetary items are remeasured. So in this scenario, we can see US company buys inventory for 100,000 pound on November 1 from the British supplier. So two accounts are involved. One is inventory, which is non-monetary items, and the other one is account payable, which is monetary items. And we know monetary items are remeasured. And the rates, November 1, $1.25 per pound, December 31st, $1.20 per pound, January 30, $1.22 per pound. Question. What is the foreign exchange transaction gain or loss on the December 31st income statement? Answer key and explanation. A. $5,000 loss. B. $5,000 gain. C. $3,000 loss. D. $3,000 gain. So here we see the exchange rate in November is $1.25 per pound and December 31st $1.20 per pound. So dollar reduced means you are going to pay less dollar, right? So per pound your dollar savings is 0.05. So for 100,000 pound it will be $5,000 gain. B will be your answer. The other way you can think that in November 1 your total liability will be 100k times 1.25 equal to $125,000. December 31st liability 100k times 1.20 equal to $120,000 liability. So your liability was 125, now it is 120. So 5,000 liability decrease means your gain. Always focus on the change in exchange rate between transaction date and the balance sheet date. If you understand this concept clearly, you will solve many CPA questions much faster. So, all right, that's the foreign currency transaction life cycle. Remember that 3 days, dance, transaction date, reporting date, settlement date. And always ask yourself, is this monetary item or non-monetary item? That single question will guide you to the correct accounting treatment. If this lesson helped you to understand the concept more clearly, please like the video, share it with other CPA candidates, and don't forget to subscribe, press the bell button so you never miss the future lesson. Here at your CPA School, our goal is simple. Concept first, confidence always.